Good morning, everybody. My name is Jamie Allison. I'm head of real estate at Napton Solicitors, and this morning we're having another brief conversation with some interesting guests. My guests today are partner from Moore and Smalley, Colin Johnson, and we've also got Business Development Director Clive Briggs from Reward Finance, and I've also got Jamie Grimshaw, who is one of the investment directors at FW Capital. And the reason that we're getting together this morning is we want to listen to what the two different funders have got to say, because we believe that a message needs to go out to the marketplace to educate people as to what is out there for funding purposes, be it to aid the recovery from the pandemic or be it to aid your plans for growth. And the awareness, I think, is crucial. Having transacted various transactions over the last 12 months, some people have been aware of as to what's available in the marketplace and some haven't. So this morning serves the purpose of giving you a whistle-stop tour in terms of what Reward can do and what FW can do and how they work with banks, which is very important. So if I could just start with, say, Clive from Reward. Clive, could you just give us some USPs as to what Reward Capital does?
Yeah, morning, everybody. I guess our biggest USP is our speed of reaction to opportunities that are presented to us. We're not a huge organisation in terms of numbers, and our process is very short in terms of management tiers. So, my boss is a kind of senior underwriter and credit approver. So you're never more than a phone call away from getting a very quick, in principle decision, and you're never more than a kind of day away from having a formal full credit committee approval. And I think that is probably our biggest, I'd say that is definitely our biggest USP, our ability to react very quickly, closely followed by our willingness to look at a whole range of assets, whether they are personally owned by the business that's borrowing the money, or even owned by a willing third party. So our general strategy is, not what have you got, it's more how much money are you looking to raise, and what can we do to assist you to reach that goal, and which parties are you bringing to the table. And then along similar lines, which I think is where our relationship with accountants has been vital in the past, is what income streams are available to service that debt. So I guess most traditional lenders will go, my client is ABC Limited, the business owns this property, and the income for ABC Limited is X. We tend to take a far more kind of holistic view. So we'll look at, if somebody's got a group of companies, we'll go, well, they've got that income stream, but they've also got that income stream and that income stream. And collectively, we can then get far more comfortable with the serviceability of the proposed funding. So I think it's taking a step back and looking at everything and then coming up with a solution that best fits the client. And that's the most important thing. It has to work for the client. If it doesn't work for the client, we just agree, shake hands and walk away.
Understood, thank you. And in the same vein, Jamie, where does FW Capital see itself in terms of promoting its USPs?
Yeah, I think our biggest USP is we know exactly where we are in our marketplace and where we want to be. And that's governed to a large extent by the nature of the fund that we operate, which is the Northern Powerhouse Investment Fund. So we appreciate we will not get the finest of applications all the time, because that generally go to the banks and the main lenders. We are here to try and help businesses who have struggled for whatever reason to get either appropriate terms, or they've been declined by the private sector. And we're here to make a personal decision, a personal credit analysis of that business, what it wants to do, and if necessary, work with the other lenders that may be involved as well. So we've got quite, I won't say unique, but it's a very different position in the marketplace, where we know the type of clients we're going to get. We're typically going to work with another lender most of the time, or they're going to have already been declined by another lender. We are here. The whole point of the Northern Powerhouse Investment Fund is to try and help our regional businesses in the Northwest take on more staff, prosper, turn over more, and just kick on a bit. So I think that's our biggest USP. On the back of that, we've got a really experienced team, not a massive team. As Clive was saying, we're not a huge company, but we are a very experienced team of bankers and credit managers. And we will take a look at most transactions, really. We've got some criteria that we can't look at because of the fund rules, but we'll take a look at startups, very well established businesses, forecast led ones where there's maybe a lack of security or some quirk to the deal, which means it's outside of appetite to the lenders. So I think that is our USP, is we know exactly where we are in the marketplace, really.
And do you also require property to underpin your security against, or is
No.
No, you don't?
No. Again, because we appreciate we're not usually first to the table. We will take some securities by way of debentures, personal guarantees, intercompany guarantees, and things like that. But typically, the majority of the security has already been pledged to other providers, like your banks or your invoice finance providers. So we would typically look at a deal on a much more unsecured basis than other lenders will, really.
Interesting, just to try and perhaps put a little bit more meat on the bones to understand how that works. But if either of you got an example of something that you could share with us that's obviously in a confidential manner, that might just help illustrate the what role you might take.
Well, from my point of view, we have been very much concerned with CBILS for the last 12 months, to be honest. And that for us has actually been an improved security position from what we would normally do. The 80% government guarantee has been a massive improvement for us, and that has been reflected in we have passed that savings on, as all CBILS lenders should have done, in the rates to the client, basically. So I suppose that's where we've been focused on for the last 12 months, with hopefully waiting to see what the next government support scheme that's coming out, and how that transpires in terms of what security and things we'll eventually need. But so yeah, it's I suppose that's our point of view, really.
And Clive, what sorts of things have you been seeing over the last 12 months in particular? Is there any pattern, or is there anything typical? I don't suppose there's anything typical, is there, as such?
Yeah, I mean, there's been a real cross-section of opportunities across the desk for a whole variety of reasons. I guess one of the most pleasing transactions we did was to help a client buy a very iconic building over in the Ribble Valley. He was a tenant in a couple of the units and had been offered the chance to buy the entire building, which had other sitting tenants in it. And because of his relationship with the vendors and his long-term tenancy to date, he was allowed to buy it at slightly what you'd call undervalue, which is always a tricky transaction, because anybody buying anything undervalue always gets questioned. But we could see the rationale for it. The vendors gave the rationale for it. And so we geared up against the value rather than the purchase price, and then geared up against some additional security that the client had, and used multiple income streams from various other businesses that he had to evidence the serviceability. And just as importantly for us is, because we are a short to medium term lender, was what was the exit strategy for that? It was a real 7-figure kind of transaction. So it's important for us that the exit strategy is in place at some point, because it's in the long-term interest of the client to go onto a more traditional standard kind of commercial footing. And he'd already started those conversations. So that was a really good transaction to get away, because it enabled him to stay where he was, enabled him to acquire a beautiful asset and develop his and other businesses in a way that I don't think many other lenders would have stepped up and done the way we did it, and structured the deal the way we did it. So that was a really pleasing deal to do.
You mentioned term there. You use the phrase short to mid-term. What typically does the term look like? What have you seen as the quickest to say the longest before somebody goes back into mainstream clearing terms?
Yeah, so I mean, all our terms are published on our website. We're very transparent. I've been here just over 3.5 years. When I joined, our average client life was 7 months. It's now 13. And I think that's symptomatic of the type of clients we're now dealing with, which are of a better quality, who recognise what we bring to the market and how we can enable them to achieve what they want more on a slightly more long-term basis. I mean, our published terms are 2 months to 24 months. And we've got clients who've been with us for the entire 10 years of our existence because they have a certain way of working and they like the flexibility that we offer and the ability to roll facilities over. So, you know, if you agree to a 2-year term and you get to the end of the 2-year term and you're still with us, we don't go, can we have our money back, please? It's, well, do you want to stay? And if everybody's happy, they stay. So, and equally, I've had clients who borrowed the money for a week and been happy to do so. And that was to facilitate a particular need. But they recognised what we would do for them. And we were happy to do that. So term has drifted in a good way. And we're working on certain schemes that may elongate that even further over the next 12 to 18 months.
Okay, understood. And in terms of working with third parties, particularly accountants, how crucial do you find that, both of you?
Clive, I'll let you go first.
I mean, it is important because the cornerstone of what we do is founded on 3 principles, which is security, serviceability, and exit strategy. And all our lending is done on a security basis. We don't do any unsecured or straightforward debenture-led lending. So we rely on security. So that's an absolute have to have as part of the jigsaw. Serviceability and exit strategy then become 2 other key components. Now, without this sounding a bit obtuse, we don't necessarily need to have both. So if we're asked to lend at 50% loan to value for a relatively short term because the client has got a clearly defined exit strategy, which might even be a closed bridge or a sale or an MBO or whatever, then serviceability becomes less of a crucial factor in the overall transaction. And we are known to roll partial or full interest on transactions if it makes sense to do so. If the exit strategy isn't as apparent, but clearly serviceability is, then that's when we rely on people like Colin and other accountancy practices, because we need to have dialogue with them about serviceability of debt, what the accounts look like, what the forecast might look like, how they've been affected by the last 12, 15 months, what does the future look like, and so on. So they play a very important role in what we do if it is more of a long-term client and where serviceability is a key factor of the overall proposition.
Yeah, I suppose from my point of view, we deal with, as I'm sure Clive does, a big variety of different sizes of business. We deal with anyone who's classed as an SME, which is turnovers up to about 45 million. Now that could be, a husband and wife partnership company, or it could be, a very decent sized business. And the standard of internal reporting differs massively in those. As part of our applications, we will always want to see year-end accounts, the management figures, and forecasts in the majority of cases as well, and those can be integrated with P&Ls and balance sheets, and understanding what's gone in those, from an assumption point of view, what basis have you judged your sales for next year, all different types of things. We need to understand what's in them because I have to justify why we're lending it, and that's why, again, working with the likes of Moore and Smalley, it really helps put that in quite a standard format, an easily interpreted format that you can explain quite clearly, especially in today's market where we're working from home. We don't print things off. We're not collecting, the old accounts like we used to. It really helps having someone at the end of a phone or a video call like this, where you can just say, just talk me through what basis you've done them sales for next year on, and that's pretty crucial. Also, the other side of things is people might be struggling. The clients we deal with, they might not be getting a tremendous service from their current advisors. And that's part of my job, to actually recognize that and say, look, I don't think what you're getting is perhaps the best, or you need to improve this part of your management team. I think you should speak to someone like Colin, because I think he'd be able to help you understand what you're doing a bit better. And that's another important part of this role as well, is that recognizing where they might need to strengthen or help people. Because ultimately, the better the business, the more likely are they going to be able to make a success of things, and that's in everyone's interest.
I suppose the other element of what we've not quite touched on yet is is what sort of costs a business might be expecting to have to meet. You obviously in slightly different markets. Have you got some sort of indicative ideas of what sort of costs might be involved for lending?
Yeah, I suppose from our point of view, we're very straightforward. It's all to do with your company credit score, to be honest. So part of our initial inquiry, once we get an application form through from a client, is to have a look on the company's credit reference search and see what their credit score is, and that we put into a table. So, for example, from CBILS, we're probably ranging between 5 and 8% fixed, 5% for the very best credit scores, and 8% for the higher risk ones as well. We typically have an arrangement fee of 2%, and we typically have an early redemption fee of 1%, albeit if it's a short-term deal, we recognise that, and we can amend those if need be, because, like Clive said before, we're probably not as short-term as Clive, but we are a shorter-term lender than some other ones. So our maximum term is 5 years, and if we get cleared off by another lender in the meantime, stuff like that, we see that as a really good success story. So we understand what the deal makeup is, what the exit strategy is, and we put those conditions in from the outset so everyone knows what they're working to.
Yeah.
I guess headline numbers for us, and I just repeat the point that we, on our website, all our costs are there, so we don't hide anything or change anything materially if somebody comes to us with a proposition. So term wise, 2 months to 24 months, debt wise, 50,000 to 5 million. We're a monthly interest only lender, so we don't demand any capital repayments. And our range of rates is from 1.25% per month to 2% a month. And that rate is driven generally by the quantum of the debt. So if somebody comes to us for £50,000, it pretty much costs as much to set a transaction up like that than it does if someone wants to borrow 3 million. And arguably they're the more challenging transactions because you're dealing with people who haven't got a sophisticated accounting function. Yeah. The security generally is very, very tight, but you want to help them. So rate-wise, that's where we are. But I think our strategy has always been, I wouldn't say we're rate sensitive, but it's about affording an opportunity. So we don't, with the rare exception, we don't expect people to be with us for a long time. So this is about affording an opportunity for somebody to either acquire a property where they've been let down, or where what they were told was going to happen is going to be delayed, or it's come up all of a sudden, then they need to act quickly. And we have a full expectation on those occasions that probably within 6 to 9 months, we won't be part of that client anymore, because they will have gone to either someone like Jamie, who might offer a medium-term solution before finally going on to a longer-term solution. Or it might be purely opportunistic. So someone who can, almost akin to trade finance, somebody who can import something for X and sell it for 2X, doesn't mind giving away 2% a month of that if they're making 40%. So it is about what the opportunity represents and the costs relative to that. In terms of other costs, we try and avoid valuations where possible. So we will use existing ones if they make sense. We might ask them to be readdressed. Where residential properties involved, we'll look at comparisons on the likes of Zoopla and Rightmove and so on, and we'll assess the market. Arrangement fees typically are from 2 to 4%. occasionally we'll charge an exit fee, and because all our deals have got security, there's always solicitors involved at our end, and their costs vary from 2.5 up to, depending on how complex a transaction can be. But generally, kind of 5-6 is the most I've seen on a transaction. And that's where you've got multiple security, multiple leases, several personal guarantees, etc. Deeds of priority, where it is a really complex transaction. So the beauty about us is our arrangement fee, the legal fees, we add them to the facility amount. So if the client wants 100, he gets 100. His facility agreement will be for a higher amount, but we facilitate that. So in essence, the only upfront cost they have to find may be for their own solicitor to advise them on the documentation. So we do make it as easy as possible for the client, and those costs are borne by us and only paid for by the client at the end. But very transparent in what we do.
Good. Okay, thank you for that. Jamie, case study wise, what can you share with us that has been that sort of typifies what you will support, I suppose, in the market?
Yeah, I mean, we see a wide variety of different kind of businesses. So over the last 12 months, it has been CBILS orientated, and we have done those for a big variety of ones where either there's been a change in the working capital cycle of the business. So maybe there's been delays in the suppliers getting goods to them. Now that has then facilitated a more working capital facility requirements. Normally our introductions come from other people like banks and accountants. So the bank might think, actually, this is a really great client of mine, but we're just full for at the moment, or it's just that bit outside our affordability or our security structure. That's when they typically pick the phone up to me and say, would you have appetite to put a bit out for this if we do this amount? So I've got one at the moment, which is exactly that, which is a leisure business operating in England and Wales. Weren't trading for a tremendous time before COVID impacted them, about 18 months. The bank have helped as much as they could. Really like the business, but it's just not something they can help any further. They put it to us, and we're going to put out about £750,000. And that business has been shut for the past 5-6 months at the moment. Hopefully reopening next month, but it generates a large amount of cash when it's open. It's proven operate. It's a great concept, and we're happy to support something like that. So that's one of the other things that drives us is about job creation, job safeguarding as well. And we've also got a private sector leverage kind of aim where we want to work with other lenders as well. Those are the key things we want that make a deal a really good one for us.
And are you restrained geographically, Jamie, with your proposition?
Yes, we are. So the deals we do are for the betterment of the Northwest. So if the business is based in the Northwest, then that's great. That's Cheshire, Merseyside, Manchester, Lancashire and Cumbria. Then that's fine. If a business maybe is based in London but wants to open an office in Manchester, we can look at that for them as well, that kind of transaction. We can't do certain things. So, for example, we can't do refinance because that would be in competition with the private sector. So we're here to do some fresh lending and things. And there's a couple of sectors where we can't help, unfortunately, and that's because of EU rules and stuff around the fund. But yeah, so we are really here for the Northwest, for B2B kind of businesses and B2C now as well, which is a fairly recent thing last year. We can now look at more retail, more leisure type businesses, which is obviously a sector of the economy which has suffered massively, and we're happy to try and help with those if we can.
Thank you very much. Colin, anything else to ask the gents while we have them together?
I suppose same question that's just been asked to Jamie. It'd be interesting for you, Clive. Is there there's no geographical?
No, I mean
this for you.
We literally can now lend in Scotland. We've never lent in Scotland before. We've been able to take Scottish assets, but we've never been able to lend to Scottish companies. That's now changed. I think there'll be a formal announcement coming out imminently, maybe even this week. So we can now lend in Scotland. We lend all over the UK. We've got clients in Cornwall, clients in the Northeast. So we are full UK. I don't think we've got any clients in Northern Ireland, but we would happily lend there if the right deal came along. So yeah, full UK coverage.
And for both of you quickly, is there is there any restriction on the type of entity that you'll lend to? Is it mainly companies, or do you also lend on partnerships, sole traders?
No,
Is there an issue?
yeah, sole traders, partnerships, LLPs, limited companies, PLCs, the full trip. Yeah, absolutely. Got no issues with them.
Yeah, for us, I'd probably just add as well that we do have sister offices in the Wales area and in the North East as well. We have different funds in those areas as well to help with properties and other different things. So even if a deal comes to me and it's in Yorkshire or in Wales, for example, I can pass them on to colleagues and we can help them in those areas as well. And in terms of companies, they would very much typically be limited companies, to be honest. We wouldn't see very many sole traders or partnerships or anything. It would be limited companies.
Okay.
Thank you, everybody. I think that's been quite insightful. As I said at the beginning, we wanted to sort of spread the educational message as to what's out there for funding purposes. So thank you to Clive, thank you to Jamie, thank you, Colin. We will post this on our website, and if you need further details as to what Clive can offer or Jamie can offer, or indeed Colin, then the details will be there. So thank you very much, gents, and happy trading.
Thank you.
Thanks, Colin, Jamie. Thank you.
Thanks a lot.
See you.
Bye now. Bye-bye.
Bye-bye.